Hi everyone, my name is Rodrigo Mandeville. I'm an investment advisor in Mandeville Private Client. I'm also a financial security advisor with Zachary Simpson and Associates. I'm also CFA charter holder. I have the Charter Financial Analyst designation. And today I want to talk about what's going on right now. I mean, a lot of people are not getting the level of protection that they were expecting from public bonds. And I want to talk about public bonds because they are also there are also alternatives to public bonds in the private market. And once again, as I mentioned in a previous video, the most successful investors out there understand the benefits of accessing the private and alternative investments. They apply a specific set of wealth creation principles and business attributes to build their portfolios. The reason why they've been successful is because they have different structures compared to the typical investors' portfolios out there, which in my experience they are comprised of 100% public investments. And the reason why they add, for example, private investments, especially alternative to private bonds into the portfolios, is that because private investments tend to reflect their true fundamental values. They tend not to be affected by the forces of supply and demand and the emotions of the day, whereas the public markets, including the public bond market, they tend to be affected also by the force of supply and demand and the emotions of the day. And by doing that, the most successful investors tend to improve the quality of their portfolios, reduce the volatility, and increase the probability of a better return in the future. And I want to illustrate right now with with an example. But before that, I want to say that there is also a misconception out there that private investments are only accessible to the very big, very wealthy institutional investors or very wealthy investors, or that they're just because they are not in the public sector, they are not of good quality. And that's not the case. These investments can be accessible to other kind of investors, not only the very wealthy, the big institutional investors, but also retail investors as well. I mean, their quality, they are also very good quality investments, and sometimes of better quality compared to a similar company of the same industry, but in the public side. Sometimes there are companies that just choose to stay private. And I just want to illustrate right now with an example of what I'm talking about and what clients can experience. I'm not going to be talking about the quality, but just what they can experience by owning or adding, let's say in this example, an alternative to public bonds in their portfolios. So I'm just going to. So this is just an example of a private investment. This is a Canadian company, and they have their US dollar fund, and they specialize in short-term lending. And the returns that investors usually get is whatever this company charges to borrowers above prime minus their fees. And these are annualized returns. And so the variability is just a reflection of the difference in interest rates over the years. And the company maintains the policy, the policy of keeping the unit value at $10. And obviously past performance cannot be used to predict future performance. But if an investor who have invested $10,000 since inception and will have reinvested all the distributions, well, the $10,000 will have grown to about that amount over the years. And this is just to illustrate that private investments are not affected tend not to be affected by the forces of supply and demand and investors' emotions of the day, since they are not publicly traded. And if we can compare this investment, I mean, this investment can be used as an alternative to public bonds. And if we can compare it to the typical total public bond market investment or aggregate bond investment out there, can be an ETF or a mutual fund, the US or Canada. Well, investors have experienced a lot of variability with bonds recently, and some negative returns. And if they combine just public bonds with their public equities, well, although there is some diversification, that level of protection has been a little bit broken lately. And by adding private investments and alternative investments, they can lower the volatility and increase the quality of their portfolios and increase the probability of achieving better returns in the future. And this is the reason why the most successful investors out there also include in their portfolios private and alternative investments to their they add into their high quality public investments. And I'm not saying that people should neglect public investments. It's just by adding private and alternative, they can improve their portfolios. And I just wanted to share this with you. This is just for illustration purposes, and I wanna wish you all the best and have a great day. Bye.